Hey guys, Brian Davis from Spark Rental here. Super excited to be with you. And I am pumped to be joined today by Jim Pfeifer. He is the co-founder of Left Field Investors, an experienced real estate investor who has a passion for passive investing in real estate, like myself. So Jim, welcome to the show.
Thanks for having me on. Glad to be here.
Absolutely. So I want to start at the very beginning of your real estate investing journey, because I think you and I got into this with with similar visions and intentions, but life throws some curveballs at you. So yeah, take us back to the very beginning. Let's hear about how you got started in real estate investing.
Well, I was an accidental landlord. It was not on purpose. We built a house in 2008 and not very good timing, could not sell our old house. And so we had to rent it out and did that for 5 years. I absolutely hated it because I was the property manager and, they took great care of the house, but, it was always, something. I had to go fix something and I don't fix stuff. So after 5 years, when the market changed, I decided I'm selling this. I like the financial aspects of it, but I did not like the management. And my realtor said, well, you have this house paid off. How about instead of selling it, you get a loan on it, take the proceeds and buy 2 more rentals. I'll help you buy and I'll manage them for you. And I thought, wow, that sounds great. I didn't know someone else could manage them. I didn't know any of this stuff. So basically I turned one asset that was paid off. So there was no, there's no upside to that equity because equity in a house earns 0% return, right? And I turned one asset that had one income coming into 3 assets, leveraged assets that had income coming in. And then it was off to the races. I found, oh my gosh, this is awesome. Bought, I think 7 or 8 more single family properties. Then I thought, well, 1 door is great. So multifamily, let's get 4 doors. That would be phenomenal. But I couldn't find a 4 unit. So we bought a 22 unit. And yeah, that was too much. And then we bought another 8 and 4. And we made a lot of money on these when we ended up selling them. But I was a terrible asset manager. They never went to pro forma. They never cash flowed like I wanted them to. I was just saved by appreciation, which is not how real estate is supposed to go. But I got the bug, and then I found passive real estate syndication investing, and I realized I could hire a professional asset manager to do the job for me. And then that's why when we sold all of our active real estate and we went 100% passive.
Well, you covered a ton of ground there in a short period of time, which I love, but I want to dig into some of that a little bit deeper. So you were buying single family rental properties. Most of the people listening to this show, they're familiar with that routine. Maybe they love it, maybe they don't. I hated being a landlord like yourself. But one of the things that a lot of our listeners have not done is made that jump from residential properties, the 1 to 4 unit properties, up to commercially zoned properties with 5 or more units. So tell us about that jump that you made from single family rentals all the way up to a 22 unit apartment building, because that's a difficult transition for a lot of people.
Yeah, it was not intentional. I can't claim that I knew what I was doing. I just had a realtor. Well, my initial realtor who sold me the first 3 single family said, multifamily is a disaster. Don't do it. It's a huge mistake. And so I went and found a different realtor because I wanted to do it anyway. And so I thought I was going to get a 4 unit, but we found this 22 unit the guy wanted to show me. And every step of the way, I kept saying no. And I said, okay, we'll go into contract. And he said, but you can drop out of contract. It's not like a residential. If you don't like the color of the paint, you can just end the contract. So I'm like, okay, there's no risk here. So every step of the way, I kept asking for more. I cut the price. I asked them to repair stuff, and everything I did, they said yes. And then at the end, I just found, oh gosh, I guess we're really going to buy this. And we did. And like I said, it was a C-class property, so it was really tough to manage. I was constantly fighting with the property manager to not evict tenants because I wanted the cash flow, not realizing that that cash flow was coming at a cost of having bad tenants. And so it was just a battle the whole time. I think we owned it 3 years. It more than doubled in value. But when I sold it, the best part about the sale was I sold it to somebody, a friend of mine who was really good at this kind of thing. And I knew that he would then take it and double the value in another year. I just didn't have it in me. And that's what he did. He took it over. He evicted who needed evicting. He did all the work. He had the work crews. And he doubled the value again in less than a year. And that's a win-win, right? That's what I love about real estate. I knew I wasn't equipped to do what he was going to do. he knew how to scale it and do it correctly. And so I made the money I wanted to make. And then I was able to sell it to somebody who also made money on it as well. And that's just one of the things I like about real estate. But the multifamily step, I went too big. I should have done the 4 unit and just saw how that went. Instead, I went 22, then 8, then 4, slowly getting smaller and smaller. But yeah, I wouldn't recommend it. If I had known passive investing and syndications was available, I mean, I'm glad I learned the lessons I learned. And I was fortunate to make money just because of dumb luck. The market did it for me, but I guess it's part of the journey, right?
It is. And, I have made all kinds of bad investments in my day. So, among real estate, among stocks. So,
Yeah.
No judgment from me. And at least you made money. A lot of
Right,
my investments did not make money.
Yeah, that's the bonus. I did something stupid, but I made money. So I guess it's okay.
Well, that story, it illustrates to me that concept of the cost of headaches and of hassles, right? With active investing. And you have to kind of take that into account when you are thinking about returns in general. So you had this asset that, it sounds like cash flowed reasonably well, and it certainly appreciated well, doubling in value over 3 years. But it sounds like it was a nightmare the entire time you owned it. So, how do you calculate the cost of all those headaches, all those sleepless nights? To me, that is one of the huge advantages in passive real estate investing is you don't have any of those headaches. Now, you still have risk, of course, and you still have some other downsides or things to be aware of. But let's switch over to talking about passive investing. Let's talk about why you made that switch to begin with. What it is that you love about real estate syndications and other types of passive real estate investments.
Yeah, I went to a real estate seminar put on by the radio guys or whatever their name is. Anyway, it was about how to become a syndicator. And so I went to that thinking, it hadn't sunk in yet that I was a bad asset manager. So I went, but after about 5 minutes, I realized, I want to be this thing they're calling LPs, because I didn't really know that was an option. And once I learned about that, I thought, oh man, this is it. So I just jumped in, and I did it exactly wrong, just like I did the other stuff. I was at this conference. I realized I wanted to be a passive investor. I had an old 401k rollover that was burning a hole in my pocket. So every operator I met, it seems like at that seminar, I said, hey, can I invest with you? Here's 100 grand. Here's 50 grand. And I just assumed that if you're at a conference that you must be awesome, right? Because you were invited there. And I've learned otherwise now. That's where everybody just shows up. You still have to do your due diligence. So some of those deals were okay. Others are not so much. A couple are good. But that was my start. And since then, I've learned a lot, right, with the community we started and all of that. So I've learned how to be better. But the bottom line is, the question you ask is, what do I like about it? And it's that I can hire a professional asset manager who their only job is to manage multifamily properties or self-storage or whatever asset class. That is all they do all day long. So they're professionals. So they're going to do it a lot better than I will, right? And so I think if you want to be an active investor, you have to have some kind of advantage that no one else has. You know the market better. You swing a hammer better than anybody else. You can do it more cost effectively, something. I didn't have any of that. But what I can do is I can crunch numbers and I can evaluate people, and then I can invest in them and have them run the asset. So you have to be the kind of person that's willing to let someone else take your money and run with it in a good way, right? Manage an asset. But I just kind of looked at my strengths and weaknesses and thought, well, I want to be in real estate. I know why it makes sense. I'm pretty good at the financial stuff. I just don't want to deal with, the toilets, tenants, termites that everybody talks about. And so I found a way that I could still be in real estate and not deal with those things. And so that was really compelling to me.
Well, it shows a level of wisdom that you were able to look yourself in the mirror and be honest with yourself about your strengths and weaknesses. When I first got into real estate investing in my early to mid 20s, I certainly did not have that kind of wisdom. I didn't even get any help. I was young and dumb and overconfident, hubris of youth. I'm going to go out there and I'm going to do this on my own, and I don't need anyone else. And of course, I made every mistake in the book, and it was super expensive.
Yeah.
So kudos to you for just recognizing your own limitations and what you are not as good at, and then delegating that to someone else. And I think delegating is a hard thing. It's hard for entrepreneurs. It's hard for investors, and of course, real estate investors, at least active real estate investors, flippers, rental investors, they are entrepreneurs in their own way. Even if they don't have any employees, they're still in business, on the side of their full-time job, going out and buying properties. So I love that notion that you had of, I'm going to delegate the asset management to a professional. And that's another level beyond delegating the property management, right? Which you had already been doing. So I love that. What are some of your favorite investment property classes right now? What are you excited about right now as a passive real estate investor?
Yeah, I think right now I'm a little bit cautious, but I think some interesting stuff is coming up. So right now, I really like debt is very interesting to me. I do some private lending, but I also do some syndicated debt opportunities, things that have quick paybacks like the ATM machine funds. I do like those. And then, I think multifamily always has a space, but I'm very cautious in that asset class because of all the things that have happened. Now the big rage is distressed assets. And I think you got to be very cautious on that, but there is a place for that as well. You just need to really know the operator, I think, is key there.
Well, that ties into a question that I've been quite excited to ask you is, what are some of the risks that you see in today's real estate market, and in particular in multifamily or in larger commercial properties, in the real estate syndication market? What are some of the risks that you see out there that not enough people are talking about? And the easy example is, 2 years ago, we all should have been more worried about interest rate risk, right? I mean, interest rates were super low. They had been low really for decades. No one was talking about the possibility that interest rates could go up, and they could go up quite fast. And of course, that led to a lot of people going out and borrowing adjustable rate debt, not buying interest rate caps or any of those protections. So now, of course, everyone's talking about that. But what are some of the risks that you see now that people aren't talking about, but that are very real risks for passive real estate investors?
I think patience is important. And one of the things that I see is everyone is really fired up about distressed real estate. As soon as it comes, we're just going to jump in and make tons of money. And in fact, I just said, hey, let's look out for that, right? As a positive. I will also spin it into the negative. There are some of these deals that I've invested in that didn't turn out because I was so confident and the operators were confident that they could keep flipping multifamily real estate, and interest rates, the increase wasn't the worst part. The worst part was the pace of the increase, right? And that's what caught everybody off guard. So now some of these deals aren't working out and they're back on the market, and another syndicator is buying them. And then you come by and you see, oh, there's the property I own, and now another operator is selling it. Well, you probably lost money maybe on the sell, or you will, but because it's still not in contract and all that. But I think my caution is, don't think that, hey, a new operator is running it and they're going to do things better and jump right back in on the same property, because you just lost money. So now you want to get your money back and double down on that property. And that is a risk. And if you analyze and understand it and you're with the right operator, go for it. But I think some people are so jazzed up to find this distressed real estate and to make money back that they might have lost, that they're not really thinking carefully about what that means, that it's distressed. And maybe there's underlying things that you don't know, even though you just owned the property, that just because it's distressed, or worse, just because someone markets it as distressed, that doesn't mean that it's going to be a good investment for you. So I don't know if I know, I can't see the future or guess what the risks are going to be. It's going to be, ask me in 2 years, I'll tell you what they were. That's
Right.
easy. But what I'm trying to do is just be a lot more patient and recognize that I made some mistakes in thinking that something that was repeatable before is going to be repeatable again, meaning these super low interest rates, we can flip deals in 2 to 3 years. I just recommend be much more patient and don't think that just because it worked before, it worked now. Also, the operator is more important than ever. The risk is these new operators, some of them are great, but some of them, they haven't had the difficulties. And so they might not know how to get through it. Others, then you have experienced operators who had all the difficulties and got through them 10 years ago, and this time they failed. So I think spreading your risk and not being too confident is what I would do. And by spreading your risk, diversify by operator, market, asset class. I was saying that 3 years ago, but I didn't do it enough. So now I'm doing it even more. So I'm not sure if that answered the question, but that's kind of how I'm looking at things.
Yeah, no, that makes sense. That's one of the things that we do in our co-investing club is spread our money among a lot more deals, right? In different states, different cities, with different operators, different property classes and types of properties. Because, like you said, my crystal ball is no clearer than anyone else's, but the law of averages will kick in at a certain point, and if I have my money spread among enough different types of deals in enough markets with enough operators, I'll probably be okay, averaged across all of those different investments, even though some of them will inevitably underperform, right? And that's just
Right.
that happens with any kind of investments. It's why I invest in passive index funds for my stock investments, right?
Right. Yeah,
So
absolutely.
yeah, no, that makes sense. Um, so, Jim, I want to hear about Left Field Investors that you co-founded. You guys are in a similar space as us, but you are not direct competitors or anything. I'd love to hear about what you guys are. How you were started, or how Left Field Investors got started, and then how you've evolved over the last few years.
Yeah, we joke about it, but we're a pandemic baby. We were supposed to be a 12-person dinner club in Columbus, Ohio, where we could just kind of have our own little mastermind. And our first meeting was supposed to be March 18th, 2020. And so we didn't have that meeting. We went online. And the great thing about being online is then we could get people outside of Columbus. Everyone was sitting at home with nothing to do. So we got some really high profile guests to come and teach us. And, we've spent the first year really trying to restrict the numbers. I don't want to go over 20. I don't want to go over 50. Right now we're at 1,800. So that's blown out the window. But the purpose of the community, what it's grown into, is we provide education, a network, and some deal flow to people who are interested in, financial freedom. And that's our goal. We have people that haven't gotten in a deal yet are part of our community. We have people who are in 100 or 200 deals, and they're part of our community. And the goal is, if you go out your front door and you talk to your neighbors and you say, hey, let's talk about personal finance, they're going to say, I got this interest rate on my mortgage. I put money in my 401k and I'm, in index funds, right? That's it. And then you're going to say, oh, I do real estate syndications. And they're going to look at you like you came from another planet. And the only thing they're going to know for sure is you just said real estate, which is super dangerous, and syndications, which sounds illegal, right? So you got no one to talk to. I don't think you can be a successful LP investor without a community, because that's where you get knowledge, right? You have your community, we have ours, we work together, right? We're partnering on things now. And it's all about that community because you need knowledge. And, Chad Ackerman, one of our co-founders, he heard me talk 5 years ago, or maybe 4 years ago. And he said, hey, how long did it take you to achieve financial freedom through syndication investing? And I said, 5 years. And he said, I'm going to do it in 3 because I'm going to learn from your mistakes. And you know what?
Fair enough.
He did it. He quit his regular job. He was dumb enough to start a new job. Now he works for Left Field Investors. So he's still a full-time employee, but he works for himself, right? So he ditched the W-2 in 3 years. And the point of that isn't that, oh, hey, great job, Chad. It was 3 years. The point is he used the community, the mistakes that I made and the collective mistakes that others in our community have made to shortcut the process and get it done in 3 years, right? He bought 2 years of time by joining a community. And you can't get that anywhere else, right? And again, you don't have to be in Left Field Investors. You don't have to be in your community, but join some kind of community that matches the culture of the community, matches your personality. And that is the path to success, I believe.
Well, I couldn't agree more. And, it was just a few minutes ago that I told you about how, when I was in my 20s, I was foolish enough to try to go it alone and do it all myself. And guess what? I made every mistake in the book, right?
Right.
Mistakes that I could have easily avoided if I had gotten a mentor or a senior partner or just any kind of coach or someone who had done it before.
Absolutely.
uh,
Yes.
when I had not. So, just that humility and that willingness to listen to other people who have gone before you, get some ideas from those people, learn from their mistakes. You can shortcut that path to financial independence, which we talk about all the time here on this podcast, on sparkrental.com. We're big on financial independence, but to your point about Chad, it's more about living your ideal life and doing your ideal work than it is about going and sitting on a beach somewhere sipping pina coladas, because that gets boring pretty quickly.
Yeah, absolutely.
So, Jim, how can people connect with you and learn more about Left Field Investors if they're interested in joining your community or accessing some of your educational materials?
Yeah, go to leftfieldinvestors.com. There's a couple different membership levels, but there's lots of free content on the website. And then if you want to dig a little bit deeper, you can join our paid community. It's $199 a year. And then you'll be an infielder and get access to all of our deal flow and our infielder our forum where people are talking about deals and operators and all that. And we also we do calls with people who just want to learn more about it. So you can set that up. There's a button somewhere on the website that says connect with us, or you can send me an email, jim@leftfieldinvestors.com. I'd be happy to chat with anybody who wants to learn more.
Awesome. Well, Jim, thank you so much for coming on today. This was a lot of fun. And I'm sure that a lot of our listeners are going to go check you out, because I personally love what you guys have been doing. And I know they will too. So thanks again.
Awesome. Thank you, Brian.
Absolutely. Well, we will catch you guys next Tuesday at the same time, 2 p.m. Eastern, 11 a.m. Pacific. And if you have any questions, comments, let us know. Support@sparkrental.com. Please rate and review the show if you've enjoyed these conversations that we have. And we'll catch you on the flip side. Bye now.